Good morning, ladies and gentlemen, and welcome to the show this Thursday morning, the 16th of December, 2021. Thank you for tuning in. I'm glad to have you guys here. Now, here's what I want to talk about. First off, toward the end of this show, after I do the markets, I'm going to talk about a curious effect that high inflation can have on interest rates. But first, we're going to get in there and we're going to talk about the city of London. Here's the thing, guys. I'm watching London like a hawk. I'm talking about London, England. And the reason why I'm watching London so carefully is because they're ahead except for South Africa, they're ahead of almost everybody on the Omicron virus. And I'm watching to see what sort of an effect it has upon the city of London, because London is very similar to other Western cities. Cities like Toronto, cities like New York, cities like, well, I could go on and name all the cities, but the thing is it's very similar. So whatever the effect it has on London, I'm looking at it as a tell for what's going to be coming soon to other cities. I'm watching London very carefully for you guys. Now, the next thing I want to say is the Fed's come out here and they've did what they're going to do. They've done it. Well, what's going to be the net effect? We saw the net effect. Markets went up. Everything's going up. Gold and silver's going up. Everything's going up. This is a huge indicator, guys. A huge indicator that it's too little too late. That inflation must be over 10%. The real inflation out there. Even though they're putting in a print of what, 6.8% on the CPI? Actually, it's much higher. And there's an interesting effect that occurs regarding interest rates and inflation when inflation gets really, really high. Now, this is an indicator that the inflation right now is a worse problem, much worse problem, than the inflation that we experienced back in the 1970s. But, you know, Paul Volcker, during the Volcker era, they raised interest rates. And the interest rates were much higher than they are now. And they raised interest rates to try to quell off inflation. But here's the thing. Well, I'm going to get into that toward the end of the show. I'm going to explain to you what that's all about. First, we're going to do the markets. Like I said, so let's get the markets opened right here. Take a look at what's going on. We're seeing the silver price today really moving to the upside. It's at $22.49. It's up 43 cents on the day so far. And, you know, I mean, this is everything to do with what the Fed did yesterday. And you know, it seems counterintuitive, you guys, and it was at first to me. I was like, what's going on with this? You know, the Fed's come out and they've hit everything as hard as they can. We're going to taper in the next 3 months or whatever down to zero, and we're gonna start raising interest rates next year and everything. And the markets all went up. Gold and silver went up. Bitcoin is probably, I haven't checked it yet, but I think it's going up too. So I was like, what the heck? And then it dawned on me and I figured it out. That's what I'm going to talk about at the very end of the show, is this curious effect that occurs. But let's move on now. We're looking at a silver price of $22.49. It's up 43 cents. I'm sure you guys like seeing that. Gold today. Gold is up too. It's up $19.10 at $17.96. Now let's check cryptos. And it's at 22.59 billions. Let's refresh the page. 22.67. So yes, it's going up right now while we speak. 48,600 for a Bitcoin. Okay. Let's move on and take a look at the Dow Jones Industrial Average, which is up 214 points in a day at 36,141. Now let's take a look at the crude oil. You know, the central banks. I'm going to tell you guys something about the central banks real quick. The central banks are really the ones who are controlling this world right now. They get the money printer. That's control. You know, the old saying used to go, he who has the gold makes the rules. So basically it's the same thing, right? The central banks. And, you know, they're not going to stop. They're going to keep going with this until they've basically completely and utterly destroyed the middle class. So most of the people out there, people listening to my show, you're all middle class. I consider you middle class. I consider everybody out there middle class if you got less than $10 million. I consider you middle. I mean, if even that's a low estimate. To be out of the middle class, you'd have to probably have, now, with the way inflation is now, maybe 100 million to be out of the middle class into the rich. But, you know, and the middle class extends down, and way I consider it, right down to where you could be almost homeless. I mean, you're still middle class. If you got a home, any sort of roof over your head, I consider you to be middle class. I consider you to be poor once you don't have a roof over your head. Like homeless, you know. Then you're poor, and I consider that to be poor. But so I consider the middle class to be all those people in any range, you know, depending on, make different amounts of money, but all middle class. They're the one. These are the ones. These are the people. The people. That's the middle class. It's the people. They're being bankrupted slowly but surely by a hidden tax called inflation, heaped upon us by the Federal Reserve. Meanwhile, the Federal Reserve's out there just printing willy-nilly as much as they want, and they're buying up all asset classes. And I'm going to tell you what, they're going to bankrupt all of us, ultimately. It's an institution that has basically secured itself to the financial system to the point where if you try to remove it, the patient dies. At this point, it's like one of these things from movie Aliens or something, you know. If you try to, it's sucked itself on, you know, like a fungus, you know. It's sucked itself on to the financial system, and if you try to remove it, the financial system goes terminal and dies. That's the kind of situation we're in right now. But at the same time, they're not going to stop. They're just going to keep going until they've bankrupted everybody in the world except themselves. You know, I mean, it's a Ponzi scheme, and Ponzi schemes have to go to a conclusion, and the conclusion of this Ponzi scheme is something called hyperinflation, where they're basically taking your savings, and that's it, poof, gone. It reminds me of that cartoon. You guys ever watch? I should link it. You guys got to watch it. It's really great. You got to watch it. It's on South Park, you know, and I'm going to link it in the description. But it's so funny. You just got to watch it. It's the bankers. I mean, anyway, I'm getting sidetracked here just a little bit. Crude oil is at 71.69 right now. Now let's take a look at the MOVE index, which is at 74.06, and it's down a little bit today. It was up to 90, but it can shoot up so fast. We got to keep our eye on this MOVE index, because if it shoots up, that's a strong indicator of instability in the credit markets. Bonds and rates today, we're seeing a mixed bag with the long end rising and the short end falling, but insignificant moves. Except in the 1 year, it's moved 2 basis points. Oh, wait. The 2 years moved even more. No, they're moving. Bond yields are moving today here. Like, I thought it was insignificant, but it's not. They're moving, but it's in the lower end of the range, and they're falling. Yields are falling. Looks like it's fairly significant though. It's on some of the lower end of the range here. Looks like the 5-year has had a significant move to the downside. But bond yields are historically low right now. You know, at 10-year at 1.43 and the U.S. 30-year at 1.86. We still have that inversion between the 20 and 30-year. Okay, let's move on and take a look at the dollar index today. And we see the dollar index is starting to rise a little bit, but overall it's falling. over the day. Unless it rises some more, then I can say it's flat, going flat along the board, but it's not. It's dropping today from what it was. Okay, now let's talk. We're going to talk about this curious phenomenon that occurs, where if inflation gets too far, see, normally interest rates are used to control inflation. That's when you're dealing with normal inflation levels. So you raise interest rates, makes it harder to borrow money, slows down and cools down the economy, and then what happens is inflation starts to come down because it lowers consumer demand. That's in a normal economy. What's happening is we're moving toward hyperinflation right now, and this economy is not normal anymore. And when you get rate of inflation starts to broach, say, I'm just going to guess, say 10%, in excess of 10%, real inflation. I'm not talking about their CPI that's all doctored, and it's only 6.8%. I'm talking about real inflation. When it broaches 10%, a curious phenomenon occurs. A small interest rate rise, when you get massive inflation, a small interest rate rise will actually have the opposite effect of increasing inflation, because it's a value of money on term. It's a term value. You see, inflation affects the term value of money. In other words, investors know that if inflation's at 10%, they know that that money invested, that they have to actually quite literally get more than 10% to account for the loss in their money in a year. In other words, a dollar is only going to be worth 90 cents at the end of the year if you got 10% inflation. And in that case, when you raise interest rates an insignificant amount, you actually heat the inflation up. You make the inflation worse. In fact, you create an inflation spike. If you're only going to raise the interest rates by just a few basis points, like what the Fed's planning on doing. It has the opposite effect when you get an inflation rate that's over 10%. And so these interest rate hikes that they're planning for next year are going to have exactly a counterintuitive effect. In order for them to have the effect that they want, they would have to raise the interest rates over 10% on the treasuries, because the inflation's run away on them at this point. It's become counterintuitive. So what this means is they're only going to heat the inflation up even worse when they start hiking rates. And this is a big worry because they're so far behind the curve. And they can't catch up with the curve either, because the inflation rate is obviously now above 10%. It's not the 6.8% that they're talking about on the CPI. That ain't it. Inflation rate now is probably running as hot as 15% right now, especially on food items and things like that. Now, they come out there and they raise it, what, they plan on raising 25 basis points or some silly little thing like that? That's just going to have a counterintuitive effect, and what we're going to actually see is that make the inflation even worse. And this stopping of their we can see the markets just laughed at that. This market is reflecting a hyperinflationary stance right now. It started to, and that's the reason why it didn't have the effect that we were all expecting to see the markets go down. Like, remember the taper tantrum that markets had a few years ago? This is having exactly the opposite effect. It's sending markets up, stimulating markets. This is because they've lost control now at this point. And so I'll explain it to you guys this way. It's like a fire. Normally, intuitively, you say, okay, I got a bucket of water here, I got a fire. I'll put the fire out with a bucket of water. And normally that works, and that's the way with inflation and interest rates. But in this case, what's happened is this is an oil fire. And when they throw the bucket of water on it, they're going to get a counterintuitive reaction. I think now at this point, I think we're off to the races. Inflation is not just transitory, it's starting to take hold. And it's a monetary phenomenon that has to do with confidence in the fiat currencies themselves. And what's actually starting to happen is confidence is starting to be lost in the fiat currencies. Now, what we're going to have directly ahead is, I believe by this summer, we're going to have the virus is going to start to go into the back mirror. It's going to start to go behind us by this summer. And right now we're into a surge. It's coming in strong. But this isn't going to last very long. I don't see it having a lot of staying power. It's going to be a short-term thing where it's very severe. It could be very severe, but it doesn't have the staying power, right? Because it's moving so fast. In other words, it's like there's different kinds of fires, you know. You got fires that slowly smolder for weeks, months, years. They got underground fires, you know, in the United States that are burning down in mine shafts and stuff like that, and they've been burning for like 30 years. And that's the way it was with this COVID thing, you know. It was slowly moving, you know, and like a smoldering fire. But no, this Omicron is like a prairie fire in dry grass. Okay, so by this summer, we're probably going to be looking at the economy starting to bounce back rather rapidly, and this is going to help fuel the inflation. Plus, what the Fed's trying to do to stop it is like, right now, I can just see it. The markets are responding that way. It's like somebody trying to stop a train with a butterfly net. Okay, and this is just smashing right through. It's not the reaction, I'm going to be honest with you guys, not the reaction that I expected. But now that it's happened, I can see it should have been the reaction that I was expecting by the markets to this, what the Fed's doing. It's basically over, guys. We're headed toward a hyperinflation that is going to cause massive societal upheaval and changes in the world like you've never seen before, once it really starts to hit. And I think when this problem hits, the problem of hyperinflation, we're probably going to have the COVID thing in the rearview mirror at that point. And it's going to be center stage. And it's going to cause massive upheaval and problems like on the scale but it's not imminent. I'm going to get to this point. It's not imminent. In other words, we're going to have a little period here, I believe, coming up in 2022 where things start to stabilize a little bit. We've had such a turbulent period over the past couple years, you know. Anyway, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.